You make good money, real money, and yet the bank looked at your tax return and basically told you to go kick rocks, right? You're depositing 6 figures a year into your accounts, you're running a real business, you're living well, but your CPA is doing their job and they're writing everything off under the sun. So on paper, you look like you're barely getting by. And now you think that you can't buy a home. That's the lie that I'm going to destroy in the next few minutes, because there is a loan that's designed specifically for people like you, and it doesn't use your tax returns at all. It uses your bank deposits, and the math behind how it works is so simple, it's going to make you mad that nobody told you this sooner. If you're self-employed and you're serious about buying a home this year, quick heads up, I did a free training that walks through this entire process step by step. The link's in the description, go register. So here's the setup. Traditional mortgages, conventional, FHA, whatever, they all want to see your tax returns. Specifically, they want to see your net income on your Schedule C. That's the gross revenue minus all of your deductions. And if you're a smart business owner, you're writing off your car, your home, your office, your travel, your meals, your software, your phone, all of it. That's literally what your CPA tells you to do. Pay less in taxes. And it's great advice until you go to try to buy a home. Because now the lender looks at the bottom line on your tax return and says, sorry, you only made this much. I had a borrower, all right, a consultant, brilliant guy, deposits showing north of $15,000 a month coming into his business account like clockwork for 2 years. But after his deductions, his Schedule C showed maybe $4,000 a month. And a conventional lender told him that he could barely qualify for anything worth living in. He came to me convinced that homeownership wasn't in the cards. And I told him, no, you just talked to the wrong lender. Now, here's where the bank statement loan enters the picture. And I need you to pay close attention, because this is the part that actually changes how much house you could buy. A bank statement loan is a non-QM mortgage, standing for non-qualified mortgage, which just means that it doesn't follow the standard Fannie Mae and Freddie Mac playbook. Instead of tax returns, the lender looks at your bank statements. 12 months or 24 months, depending on the program and which option makes your income look stronger. They pull every single deposit, client payments, invoices, direct deposits from your business activity, and they add them up. They then divide the number of months. So if you had, say, $300,000 in total deposits over 24 months, they divide by 24, and you get $12,500 a month in average gross deposits. Simple division. That's step one. But here's where it gets interesting. And this is the piece most people miss, so don't zone out on me. If you're using personal bank statements and you're paying yourself directly into a personal account, many lenders will credit up to 100% of your deposits as your income. That's huge. But, and this is a big but, if you're using business bank statements, the lender applies what's called an expense factor. Think of it like the lender saying, okay, we know not every dollar that hits your bank account is profit. Some of it goes to overhead, supplies, employees, whatever. So they discount it. The most common default expense factor across the industry is 50%, meaning if your business deposits an average of $20,000 a month, the lender may only count $10,000 as your qualifying income. Now, before you panic, let me tell you the move. And honestly, this one insight alone is worth more than everything I've said so far. If you have a CPA, and you should, your CPA can write a letter to the lender stating your actual business expense ratio. So if you're a consultant or a coach or a freelance designer and your real expenses are only 15 to 20% of your revenue, not 50, your CPA puts that in writing, the lender accepts it. And suddenly your qualifying income nearly doubles compared to that default 50% factor. I had a borrower, a marketing agency owner, business deposits averaging about $22,000 a month. Under the default 50% expense factor, she would have qualified on $11,000 a month. Not bad, but limiting. Her CPA wrote a letter confirming her actual expenses ran about 25%. That bumped her qualifying income up to $16,500 a month. Same deposits, same person, same business, completely different buying power. Same woman, totally different outcome. Just because we knew how to structure the file. And that right there is why who you work with matters more than which program you pick. If you want to see the full breakdown of how to set this up right, how to prep your bank statements, what deposits count, what gets thrown out, and how to maximize your qualifying income. Again, I did a free training on exactly this. Links right in the description below this video. Go grab it. So let's answer the questions you're probably thinking right now. What deposits actually count? Eligible deposits are your regular business income, client payments, revenue, invoiced work. What doesn't count? Transfers between your own accounts, loan proceeds, one-time insurance payouts, gifts, anything that isn't actual earned income from your business gets stripped out before they calculate. The lender is looking at real, reoccurring business activity, and they want to see consistency. A borrower with steady deposits month after month is always going to look stronger than someone who has two massive random deposits and then nothing for 3 months. Actually, let me back up on that because it's important. Even if your income is seasonal, you could still qualify. Let's say you're in real estate or construction and you make most of your money between April and October. They still add up the full 12 or 24 months and divide that by the total number of months to get your average. So seasonal is fine. They're looking at the full picture, not month by month. And here's one more thing that trips people up. You typically need at least 2 years of self-employment history. Some programs will accept 1 year if you're in the same industry as a W-2 employee before going out on your own. But the standard is 2 years. If you've got that, you're in the conversation. So let me bring this all the way home. You're not stuck. Your tax return is not your identity as a borrower. Your deposits are. And the lender can do the math on your actual cash flow, your real money, and qualify you based on what's actually hitting your bank account. If you're self-employed, you're earning 6 figures or more, and you've been told no because of your tax returns, that answer was wrong. It was the wrong product, the wrong lender, or the wrong loan officer. That's it. Now, do 2 things for me. 1, go register for that free training I mentioned. The link is in the description and in the pinned comment. It walks through everything we covered today, but with way more detail. And 2, subscribe to the channel because we're always breaking down the biggest mistakes that self-employed borrowers make before they even apply.